In Chapter 5, what we're looking at is how interest rates are essentially determined, more specifically the nominal interest rate. So in the previous chapter, Chapter 4, what we had done is looked at what is an interest rate, and more specifically, how the interest rate reflects the yield to maturity, and that the interest rate plays a key role in determining how we calculate the future value of money that could have been received today instead. Now, in this chapter, what we want to look at is how is that interest rate determined? What that does for us here is we need to go through a few steps. The first step being we need to define what is an asset, basically an asset that's going to pay an interest rate. Then we're going to look at the bond market, and we're going to look at how the interest rate is determined within the bond market. And we're going to explain both movements along the demand and supply curve as well as shifts of the demand and supply curve. Then what we're going to do is look at the other source of where money can be. So money, besides being in bonds, can be in the money market asset class. And we're going to look at the demand and supply for the money market and how movements along those curves and shifts of those curves as well. And when we look at the difference between the bond market and the money market, really what we're talking about here is what is your preference for liquidity, its translatability into cash. The money market has more liquidity than the bond market, yet each are of rather similar, although not the same, risk preferences. In fact, money markets as an asset are typically invested in bonds, short-term bonds. So money market is just an easier way to access the bond market. But as a result, it also pays a little bit less interest because you have a bit more liquidity. So let's start first with what is an asset. Basically, an asset can be anything that is owned and has value. Houses are an asset. A car is an asset. Now, is a car a good asset? Well, unless it's like, I'm not a car guy, but right, unless it's like one of those really, old classic ones or, incredibly unique. Some people say, well, cars are a bad asset because they lose so much of its value, in the first year or, the moment you drive it off the lot. And that is true, and that may make it a bad asset, but it is an asset nonetheless. A phone could be an asset. A computer could be an asset. Your investment in your college education is an asset because you own it, and it obviously has some value. So, when we look at particular assets then, and how many assets you own versus consumption goods, right, which are kind of the opposite. A consumption good, the value is immediately diminished by the fact that it is consumed. In terms of the overall demand for an asset, it's determined by four things. Which kind of asset you prefer. Wealth, expected return, risk, and liquidity. Well, wealth is a pretty easy one. The more wealth one has, the more assets one has. That shouldn't be too surprising. What is the expected return to that asset? If the expected return to a certain asset is greater, then more people will demand it. That's kind of what's going on with something like GameStop, right? Is that it was a dying retailer, in 2019. I mean, I remember going to one because my kid wanted, like, Dance Dance Revolution. And I like DDR as much as the next person, but, dude, that store was creepy. Like, it's just a weird crowd. I shouldn't say weird, I'm being judgmental. They are not the typical individuals I would hang out with. So if I were thinking, should I invest in GameStop as a asset? No way. It was declining in number of stores. The firm wasn't making any money. So compared to the alternatives I could have invested in 2019, it was a pretty bad asset, and why would I want that stock? As opposed to 2021, where I know that a lot of people are buying that stock because everyone's expecting that stock value to increase, even though the reason for the stock increase is deviated from the realities of that asset. And then we've got the risk. That would be the amount of uncertainty, variability that comes with the return on that asset. So something like a there's a great deal of uncertainty in investing in an international stock market, I think. My wife and I disagree about this. Probably one of the few things we highly disagree with. My wife believes that international assets, international stock funds should be a part of everyone's portfolio, and I think it's a pretty bad idea. And the reason why is that we differ on the basis of the risk. Now, maybe I'm too much of a homebody. Maybe I've spent, maybe too much time investing in the U.S. stock market, but I don't have enough time to learn about all that's going on in all of the countries that could be participating in an international stock fund or an international bond fund. And I can't keep up with the politics and the tax changes and everything that's going on in these other countries that's going to affect my asset value. So I just think the risk is too great relative to other things I could be investing in. And then the fourth thing is liquidity. How quickly can it be turned into cash? So there's some things like real estate investment trusts, REITs, that are not incredibly liquid, as opposed to a gold ETF, exchange traded fund, which could be bought and sold in the stock market as long as the stock market is open. Now, we went over these different kind of assets and what's affecting the demand for each of them, because now what we want to understand is portfolio choice. Portfolio choice theory is basically a theory of how investors who are just naturally risk averse, how do they construct a portfolio containing all these different assets? How do they construct a portfolio that's going to maximize their return based on on the level of risk? What we know is that based on this theory of portfolio choice, that again, if we look at those previous factors, that again, individuals, as wealth goes up, the quantity demanded of the asset, so movement along that curve, the quantity demanded increases. As the expected return increases, the quantity demanded increases. As the risk increases, the quantity demanded decreases. And as liquidity increases, the quantity demanded increases. So, in general, we're going to see a demand curve for an asset where any of these variables increasing, generally, with the exception of risk, leads to the quantity demanded increasing. With risk, it's obviously inverse, unless you're a risk-loving person. But this model, again, presumes that individuals are risk averse, so they don't want to take on more risk. Now, if we look at one particular asset, that asset being the bond market, what we know is that the interest rate is basically the reward, the return for investing in a bond. And in general, if interest rates are increasing, then the quantity demanded increases. Now, interest rates increasing is reflected in the fact that the price of the bond is being sold at a discount. To understand this a different way, what this is saying is that the bond, when it was initially offered, let's say in 2015, offered a 1% interest rate. And that today in 2021, maybe the interest rate is 6%. So because the interest rate is now 6% and this bond only offers 1% interest, if I want to sell this bond, have to sell it at a discount to get someone to buy it. So the price is down and the quantity demanded can then go up. In terms of supply and the quantity supplied, we see the typical positive relationship where the quantity supplied falls if I have to sell this bond at a discount. And that's exactly what we see here. So what this is essentially saying is that, let's say that the bond was offered initially, it's a $1,500 bond, and that the bond paid a certain interest rate. What you would see here is that as the interest rate increases, the price of the bond falls. Inverse relationship between price of the bond and the interest rate. And obviously we meet at the point of equilibrium here, which determines basically not only the price of the bond, but also gives us what the reigning interest rate is. Now, where do we see this? We see this if you look at auctions for bonds. You can look at the results for the auctions of bonds, and you can basically, market participants can basically determine from that what the interest rate is in the economy. What this is also saying, though, is that one of the largest misconceptions about what the Federal Reserve does is that the Federal Reserve, for the most part, does not determine interest rates. It determines only one interest rate, the discount rate. That's the interest rate that banks pay when they borrow from the Federal Reserve directly. But when people say that the Federal Reserve lowered interest rates, it's not entirely true. All that they're doing is they are buying and selling bonds, meaning they're serving as either a demander or supplier of bonds, in an attempt to reach an interest rate target. So for instance, we're going to talk about things that shift curves in a little bit, but if the interest rate right now was 17.6% and they said that's too high, and they decided that they wanted to lower the interest rate, then the newspapers and everything would say the Federal Reserve is lowering the interest rate to 11.1%. But they're not actually, they have no authority to move it. Instead, what they're going to do is they're either going, in this case, because they want to lower the interest rate, then what they're going to do here is they're going to basically buy a lot of bonds. They're going to shift that demand curve to the right, which we're going to talk about here in a bit, but they're going to shift the demand curve to the right so that the new equilibrium is at 11.1. You should all be comfortable with what happens at equilibrium. that when the bond market's in equilibrium, then we know what the interest rate is. When there are periods of excess demand or excess supply, then the price of those bonds will either rise or fall, and that the interest rate would then move in the opposite direction. Now, let's get to shifting that demand for bonds. What causes it to shift? There are 5 factors that cause the demand curve to shift. And this would be among not the Federal Reserve demanding bonds, but just regular individuals demanding bonds. And here this would be wealth, expected returns, expected inflation, risk, and liquidity. As wealth grows, then the entire demand curve for bonds shifts to the right because people just now have more assets to possibly invest. As the expected return of an asset increases, then the demand for that asset increases as well. If people are expecting that the inflation rate is going to increase, then what we're going to see here is that individuals are going to get less of a real rate of return, and that's going to cause the demand curve to shift to the left. If risk increases, then the demand curve will shift to the left. And finally, if liquidity increases, the ability to turn that bond into cash, if that increases, it'll shift the demand curve to the right. So we've got wealth increasing, shifting to the right, liquidity increasing, shifting to the right. The rest, when expected returns are higher, expected inflation is higher, and risk is higher, then the current demand curve shifts to the left. With expected returns, if it's higher in the future, then it must be lower now. So fewer people would want it. If inflation is expected to increase, people don't want to buy bonds as much because that higher inflation rate is going to eat away at the interest rate. And obviously, if risk increases, then people aren't going to want to be in this asset. Here's a shifting of a demand curve, which you should all be generally familiar with. And there's our handy little chart. But I've all explained this now, so I'm not sure there's any value to me talking about it more. Now let's look at the supply of bonds. These are affected by 3 things: profitability, inflation, and the government budget. If it's expected by a firm that investment opportunities are going to be increasingly profitable, then a firm will increase how much debt it's offering, thus shifting the supply curve to the right. If inflation is expected to be higher, then firms are definitely going to borrow more because it's going to be easier to pay back those loans. And finally, if the government issues more bonds because it's running a deficit, that's also going to be reflected by the supply curve shifting to the right. And that's what we're seeing here. So, we can then basically engage in a study of comparative statics, where curves are shifting, sometimes simultaneously, and the bond market is then searching for a new equilibrium point. In this case, the demand and the supply are shifting by the same magnitude to generate a quantity that doesn't change, but a price that does change. As opposed to this right here, where if supply shifts more than demand, I can get a change in the price and a change in the quantity. We can see here, as individuals expect higher inflation, interest rates generally move with that. Again, expected inflation means that it's going to be easier to pay back that bond, and so thus you would borrow more money because you know it's going to be easier to pay it back. Now, we need to break down the market for money into two things: a market for money and a bond market. Each of these markets are in equilibrium. And individuals basically move their money between the two, between the money market and the bond market, based on their preferences for liquidity. Thus, it's called the liquidity preference framework. So both of these markets, if one's in equilibrium, then the other has to be in equilibrium as a consequence. The supply of money is vertical, as you'll see here, because that is determined by the Federal Reserve. It is independent of the interest rate. It's just saying there's going to be 300, billion in cash. But that the demand changes along that curve. And so this market, once it's in equilibrium, sorry, I'm just jumping ahead here. I was looking for the bond market picture, but we can go back here. In the bond market, we can see the equilibrium here. This bond market, it's in equilibrium so long as the money market is in equilibrium, and vice versa. Now what this means is that as things are all changing, we are all deciding based on liquidity whether we're going to move our money and keep it as money or move it into bonds. All that is going to be determined by what is the opportunity cost of holding money, meaning how much of its value could be obtained by investing in something else. And what's the expected return to having something held as money? If I put it in a checking account, which would be a convenient way to store my cash, is that going to generate a great deal of interest? It generally doesn't, which is why being cash poor is generally preferred upon. Now, the demand for money in general is determined by the, first and foremost, by the income effect and the price level effect. In the income effect, what we're simply saying is that if you have more income, then you'll demand more money at each and every interest rate. And if the price levels increase, then you'll also demand more money because you basically need it to pay for those higher prices. Again, we already said the supply curve, it's already determined by the central bank. So shifting the supply curve, that's all going to be determined by the central bank changing its decision about how much money supply is going to be there. But in terms of the demand for money, that curve is going to shift based on price levels and income. And you see this here. In this case, as income levels rise or the price level rises, it shifts the demand curve to the right. thus causing an increase in interest rates, which in turn lowers consumption, lowers levels of investment, and basically reduces the size of the economy. Which is sort of what the concern is right now in 2021. What that would require is that the central bank, if you wanted to keep the party going, the central bank would need to then increase its money supply to counteract that. And one of the concerns is that the central bank, the Federal Reserve, may not do that. In general, if we look at the price level effect and expected inflation effect, what we see here is that if you increase the money supply, then it leads to higher prices, and it leads to a higher interest rate. The same with inflation and what you expect in the future, which is why, generally speaking, the Federal Reserve is mostly concerned about inflation as opposed to GDP levels and unemployment. Their biggest concern is always inflation. Because if that domino falls, generally all the other dominoes will fall as well. As you increase the money supply, what we find is that the interest rates will fall. And as the interest rates fall, then more economic activity will happen. We would basically say that aggregate demand would increase, that the economy would expand. But again, what you have to be concerned about is that the interest rates are too low for too long, causing bad investments to be made, or that it's going to cause inflation. And you see these changes here. That in terms of liquidity, that it, generally speaking, over the short term is affected, but over the long term, generally goes back to equilibrium. So it only causes a short term effect in things. Okay, so hopefully that gives us all an idea, a greater idea, of how, now that we know what interest rates are, how that interest rate can be adjusted within the bond market and how it's affected by the money market.